Well, howdy there, folks, and welcome into this video. I got a 5 specific warnings to give to all stock market investors out there right now, and these are going to be very important. And what I'm going to explain to you in this video is not just important in regards to the current market we're in, but this is actually going to be a video you're going to want to save to your notes in your iPhone or wherever, and come back to this video from time to time. And the reason being, essentially, is this is actually a timeless video. A lot of videos I put out are kind of relevant for that day or that week or something like that, but this is a rare video that you're going to want to come back to in the future as well, because what I'm going to discuss in this video is not just relevant to the market we're in right now, which I need to give some big warnings out there, but it's also going to be relevant 6 months from now, 12 months from now, 10 years from now. Okay, hope you guys enjoy this as always. Hope you get good value out of it. Alrighty, so first warning I want to give to everybody out there is, so there's this belief, right? And I had this belief as well, that home builders are in peak right now. 2022 is peak year for home builders, and 2023 orders are going to dry up big time, especially this summer. Why do myself and a lot of you guys out there believe this? Well, a lot of us believe this because affordability's gone. Homes aren't affordable. Interest rates have gone insane, and now there's starting to be some real fear about real estate. And so now we're starting to see price drops, things like that. And never mind if we get into an actual recession, that's not going to be good for housing. So that's why a lot of us believe that housing can be rough, right? And it's definitely very much a possibility. But that's not the only thing out there, right? And so a lot of people are thinking, hey, housing's going to be bad. I can short housing stocks or buy put options on housing stocks. But there's some issues here, okay? The first is a lot of these stocks are actually trading historically extremely cheap already, which makes shorting these stocks or trying to bet against these stocks tough. For instance, Toll Brothers. I'll just pull this one up as a good example, and a lot of these stocks would fall into this category. Toll Brothers used to trade at about an $8 billion market cap. Last time it was trading around here, the same stock price, in 2018, for instance, it was about an $8 billion market cap back then. Today, it's under $6 billion. Why is that? Well, they bought back a ton of shares over the last few years. And so during all those years, they bought back a ton of shares. And so now the market cap's actually, you're paying a true price much less what you were paying when the stock used to be $50, okay? Secondly, it's at a 0.62 price to sales ratio right now. It's at a 6 PE. What this means essentially is Toll Brothers' net income could drop 50%. It could drop 50%, and it would be at like a 12 PE. A 12 PE is not expensive by any stretch of the imagination. So think about that for a moment. This company's net income could fall 50%, and it would still not be at a high PE ratio, okay? The price to book on this one's about 1. The balance sheet's in a better place than I probably have ever seen it, right? And the stock's only up 32% in the past 5 years. So it's even though housing's better than it's ever been, and these companies are making money hand over fist right now, it's not necessarily like the stock price has done so amazing. The stock price is up 32% in the past 5 years. So it's not like we got some high-flying stock here that, and this goes for almost all the home builders. It's not like we got some high-flying stocks here that are at some crazy valuations. So you're running the risk of, what if we're wrong about housing? Also, remember, if you guys ever saw the movie The Big Short, right? Michael Burry, and you know about his shorting of the housing market back in the last financial crisis, he was wrong for the first 2 or 3 years, that short, right? And he had to answer to his investors because housing kept being strong, and he's like, it's gonna fall, and finally it did, right? And so this is kind of a situation with the home builders that makes it very, very tough. So be very careful if you are shorting the home builders or you're buying puts, okay? That's all I'll say about that. Because you could end up shorting for a while and not making any money, and then you have to pay interest on that. Or if you're buying puts, those could end up expiring worthless. So you could end up in many various problems, okay? Second of these 5 warnings I want to give to all investors out there right now is around shorting and also buying put options of fintech companies. So the belief is, right now, hey, we got a possible recession coming up. All these fintech companies, a lot of them have never been through a recession. Like almost all these companies, right, have never been through a recession other than maybe PayPal. So there's a belief that a lot of these companies are just going to have hard times for the next couple of years, okay? And there's a few factors you got to take into account if you're thinking about betting against these sorts of stocks, and these factors are very, very important. So, for instance, I think Affirm's kind of the the golden child of, this belief like these stocks are going to fail, right? So this is a fintech company that basically what they have to do with is like the buy now, pay later, right? So the belief is, hey, everybody's doing this buy now, pay later stuff, right? These people aren't going to pay back their loans, essentially, if they call them loans, right? And so that's going to leave a firm basically holding the bag, as they say, and being in a really, really vulnerable spot, and the company, could go out of business or something like that. That's the belief of somebody trying to short their stock. A lot of factors to keep in mind. One is balance sheet, right? Price to book on this one's under 3. The second piece of this puzzle is a price to sales ratio of under 6 for a high growth company. Their last earnings were actually pretty darn amazing. That makes it a little tough. We got a market cap that's down to $7 billion. It used to be about a $50 billion market cap from November. So if you look at a stock like Affirm, if in order to make a bet like that, you basically have to be betting that this stock goes to 0. And I think that's a tough bet to make, man. That's a tough bet to make, even if you are bearish that baby's going to 0, right? Hood, another perfect example of, if people are thinking about betting against a stock, I would say guess again, okay? And here's the reason. I'm going to be clear. I'm not bullish on Hood. I don't own the stock. But if you're trying to bet against this stock, you are playing with fire. And here is why. The Hood trades at a market cap of about $8 billion. The company has about $6 billion of cash on their balance sheet, which means essentially you're only paying a couple billion for the entire business, right? And I mean, at the end of the day, there's still massive amounts of people that use Hood. I mean, massive amounts. It is the player still of the millennial generation when it comes to stocks, right? And, that's just like a fact, right? And so, we're paying, you're really paying a very low price for this company already. The stock's already been obliterated. And the company trades at about a 1 price to book ratio right now. And so, if you look at something like the Hood, this is actually I think it's a very hard stock to, if you're trying to get this baby down to 0, there's almost no chance because they're so cash loaded. So you have to basically try to be bet that they're going to go down to 5, 6. It's a possibility, but there's such an immense risk that this baby goes to 15, 20, and you get caught with your pants down here. Never mind if it goes to 30, 40, 50. So the risk reward from a shorting angle is not really worth it anymore for a stock like this. Many, many months ago, hey, fair play. But now, I think it's very, very dangerous. Never mind that. Sam, who's CEO and founder of FTX, right? FTX US, he invested in Robinhood recently. He's got deep pockets. Who's to say he won't buy more? We never know. We don't know, right? Who's to say other banks or institutions won't want to get in Robinhood, right? Because at the end of the day, they got massive amounts of people that use Robinhood on a daily basis, weekly basis, monthly basis. And so, that's another thing that can catch you in some problems here. I mean, imagine a big bank all of a sudden invest into Robinhood. They're looking at it and they're like, wait, company has $6 billion in cash. They have all these customers and $8 billion market cap. Yeah. Oh, I want to buy 2% of the company, 5% of the company, 10% of the company, right? So, you run into an issue there. You look at a stock like PayPal. The stock's down 55% plus. This year. This is PayPal and Venmo, 2 of the top 3 most important and most known finance apps in the world, right? Trades at a price to sales ratio of under 4, $100 billion market cap, which is insanely cheap for PayPal, a PE ratio under 30, which on a historical standard is very, very cheap, price to book of 4, and a great balance sheet at this company, right? And so if you're trying to bet on bet against these fintechs now, I think you're so late to the game, man. So late to the game. At this point, it honestly makes a sense, especially with a lot of these companies, to be betting on the other side versus betting against these companies now. A year ago, smart decision. Now, I think the risk reward is definitely flipped in a lot of these. Whether we're talking about a PayPal, which is a company I really like, and that's why I've been buying shares recently, or whether we're even talking something like the Hood, which is not even a stock I like. But dang, when you got $6 billion in cash, all those customers, and an $8 billion valuation, the risk reward's there, right? So 3 more warnings to give you guys in this market right now. But first, I want to shout out FTX US, which will be the pinned comment down there. FTX US, you guys might know them from their partner with folks like Steph Curry, Jeremy Lefebvre, Tom Brady, only the GOATs, okay? As far as FTX, they make it so easy for you to set up your account. So let's say you want to do recurring buys. Let's say you want to buy $20 of Bitcoin each week, right? You can set it up where each week you could buy $20 of Bitcoin, or every day you want to buy $5, $10, whatever, right? You can set it up so your account continually just buys whatever crypto you're looking to buy out there. They have fees that are among the cheapest in the industry. They're one of the most trusted, if not the most trusted platform out there out of all crypto exchanges. Right now, they have a deal where you get free crypto for every trade over $10, which is pretty darn awesome. And if you use the pinned comment down there with my referral code, holy smokers, you get up to $100 in free crypto, which is pretty darn amazing. So I definitely take advantage of that. If you are looking to set up a crypto exchange account, it is absolutely amazing. And once again, do not forget to use Holy Smokers and get your free crypto. Alrighty, guys. Third warning to give it to folks out there is around margin. Now, we've had good news in regards to margin recently, and that's margin peaked out in October 2021, and basically since that time, the amount of money on margin is going down, which is essentially taking out debt to, if you believe stocks are going up or whatever, you're taking out debt to have extra money to invest out there. So the numbers have been coming out, and I would almost guarantee you it's even lower now if we were to see the actual updated number as of today. The problem is this always lags a month to a month and a half before you get the next results. So that's good. But the problem is a lot of people are still looking at margin or maybe heavy on margin, or looking at margin saying, you know what, I got to get more on margin, right? A lot of problems here. First is the Fed just started raising interest rates recently, and they're pretty committed to continue to raise interest rates for at least the next, let's say, 3 to 6 months. And then we'll see after that. Maybe they continue to raise a lot. It's going to depend on inflation, how the economy is doing. So the issue with this is, as the interest rate continues to go up, guess what's also going to go up? The amount of percent you're going to pay on your margin account. And even somebody like myself that has a customized negotiated margin rate, as the Fed increases, they also increase because of the baseline. And so you're going to end up paying way more in the future in margin interest. So let's say a couple months ago, you might have been paying 5.5%. You're probably paying 6% now. And by the end of the summer, you could be paying 7%. And it all depends on your margin rate, right? Meanwhile, if you're not making money on stocks and you're having to pay all that margin of money in, that's like getting double hammered, right, at the same exact time. So that makes it pretty darn dangerous. Next thing that makes it a little dangerous is we don't know if we're at the end of the stock market doom and gloom, or if we're just in the middle of it, right? If you look back to the 07 through 09 crash, when it was all said and done, the NASDAQ had fallen over 50%. All the indexes did. By the end of it, all the indexes had fallen over 50%, right? So NASDAQ's down 25% right now. Who's to say it doesn't go down another 25 percentage points, and then we're down 50%. And if you're on margin, that's going to be devastating, because these stocks that you might be buying that are honestly probably steal deals even here, doesn't mean they can't get cheaper, right? If you're buying Shopify at 300 something and you're like, man, this stock's a steal deal for the long term, doesn't mean it can't go to 150 in the short term, right? Or 200. And so if you're on margin, you can end up getting margin called. So this is a dangerous game with margin, is you have interest rates going up. That means, once again, like however much you're going to pay in is going to be more and more going in the future. And we don't know if if this was the worst we're going to see, 31% down, or maybe that's just child's play and we're actually going down 40 to 50%. We'll see. Jeremy Grantham had a prediction that, the S&P was falling 40 to 50%. And we only have seen about a 21% max drawdown so far, right? Right now we're 14.5%. So, that's up in the air. And so that's what makes margin very, very dangerous right now. So you got to be very, very careful of that, even though it's very alluring when you see all these stocks at significantly big discounts, right? It's very alluring to be like, oh man, I've got to margin out. You got to be very, very, very careful. And that's why I say for most folks, margin's just not even a viable option, okay? The fourth thing is the folks that are saying they're cashing out, right? And there's definitely a popular thing, I would say, over the past month or so. Seen a lot of people cash out of the market, leave the market, say they're going to come back after this year, they'll come back in 23, things like that. And there's a lot of problems with this. One is maybe that we already saw the worst, right? Was the NASDAQ 31%? We don't know. Maybe we do go down 40, 50%, but maybe we already saw the worst. So remember, it's very, very, very rare that you ever see the NASDAQ go down 40, 50%, ever. And so maybe we don't have this drawdown we've had 31%. That's not natural. That's already freakish. That's very rarely ever happens. So we just saw that, and we already had one of these moves down in 2020. So this is two of these type of moves in just the past couple of years. We had one of these in 2020 where the NASDAQ fell like 35 or 37% or something like that. And we have another one where we moved down 30% plus. That's twice in 2 years. That's pretty freakish in itself, okay? So, to now predict 40, 50%, it's possible, but you got to remember, we might never get that. The VIX is usually, this measures volatility in the market, and the VIX is usually a good measure if you got a lot more downside in the market, and we just haven't seen that sort of, I guess you can say panic in the market. And so, let's say you're selling PayPal at $80-something a share because it might go down to 40 or 50. I mean, it's all possible, but it just, at some point you get to become very unrealistic with these expectations of these stocks going down. As when, stocks are going great, people get very unrealistic about their expectations on the upside. And so we've already seen so much pain. Who's to say it's not already, we didn't already get past the worst. Second thing is you're setting yourself up for very, very bad habits, okay? And a good example is me, right? My wife always has fruit in the house, bananas and apples and strawberries and all this fruit. But dang, man, if there's chocolate chip cookies around, I ain't eating those bananas and those apples and those strawberries and blueberries, even though I should, because I'm in a bad habit, which is eating sweets, right? And so bad habits are hard to break. And if you're going to trade, right, if you're going to trade in the market, which that's a trade. So now you're shifting to the other side. You're becoming a trader. I'm going to try to get in the market. I'm going to try to get out of the market. I'm going to try to get in this stock. I'm going to try to get out of this stock. You're now trading. You're becoming a trader. You now think you can time in and out of the market, right? Which is, damn, that's a tough challenge. Ask anybody that's tried to do that. That's a damn tough challenge. And so now you're becoming a trader. You're no longer an investor. Investors don't get in and out of the market, in and out. That's what traders do. So you're setting yourself up to get in very, very bad habits, and you're going to be the cookie monster. And, kind of like I eating all the dang cookies at night when I shouldn't be. I should be eating that fruit. And, when you get into bad habits are hard to break. And ask anybody, and I'm sure a lot of you guys watching this have been through different bad habits in your life, whether they've been, eating sugar or smoking or drinking or whatever it is, right? And when you're in a bad habit, it's hard to break. It's really, really hard to break. And, when you start trading in the market, to flip back to that other side, very, very difficult, okay? Fifth thing, this is a very important one. This is maybe, definitely one of the most important, if not the most important here. Options. Options are getting, a lot of people have really gotten into options the last year or two. And here's the thing. A lot of people have ultra conviction, what I'm finding right now, about the market's going down and the market's going up. A lot of people are looking at these stocks so low, and they're like, oh my gosh, man, I gotta load up on options because, these stocks are going to skyrocket. Other people are looking at it and I believe the market's going down substantially more. And so they want to play put options, right? Many factors you got to understand about options. Most options expire worthless, right? And so, a lot of people that are buying puts or calls, their options are going to expire worthless. And so they're not going to make money on that. Now, it's always been told out there that if you write options, it's almost like easy money, but there's a lot of problems even with that. For instance, I have a friend who, wrote some options on Wish It's probably 9 months ago or so. And his plan was, he could get some great premium on those, and then he would have to essentially buy the shares, and then he was planning on just getting rid of those. Well, he bought the shares, but then the shares went down a bunch immediately, and then he was like, I'll just keep them for like a few days, and then I'll dump them. Hopefully it goes up. Well, it didn't go up. It went down more. Then he kept kind of hoping, and then it went down more, and then he kept kind of hoping, and then it went down more. And next thing you know, now he's got all these shares that he's lost 80% on, all from writing some options that he thought he was going to make a bunch of money on, right? And he made money on that initially, but then he held the shares. And so here's a problem. You can say, I'm going to do this, I'm going to do that, I'm going to do it all right, but then you wind up into a situation where it doesn't go as planned. And you're like, crap, man. It's kind of like, being in a boxing match, right? And you think you're going to do this and do that, and then all of a sudden something happens that you didn't expect to happen, and you try to change your game plan, and then all of a sudden it's like, what? Now I'm all screwed up. And so a lot of people can always make up these excuses in their mind, like, oh, I would do it better. I would be disciplined. And I tell you, it's a lot harder than it really looks. I call options the makeup of the stock market, where kind of like makeup can it looks very alluring, right? Options are the makeup of the stock market. That's that thing you look at and you're like, oh man, it looks so awesome. It sounds so awesome. And I'm talking whether you're a buyer of puts or calls, because everybody looks at that all the time like, oh, if I just bought puts on the stock, could have made so much. If I just bought calls in the stock, I could have made so much. And then other people look at writing options like, oh man, all these options expire and worthless all the time. I should just be writing options. It always looks good from the outside. And then you really get into the nitty gritty and you're like, this isn't what I thought it was. This is not anything like I thought it was. And the worst part is, when you lose money with options, like that's it. Like it's lost. It's gone. It's not like you buy into PayPal stock, right? And let's say you bought in at $150 and you think it's going to be, $350 in future years. So you buy in $150, now it's at $80, and you're like, crap, man, I've lost 50% of my money. Well, you could easily get that back over the next 6 months, 12 months, 18 months, 24 months, right? Plus some. In an option, that's not the way it works. Like when that option expires, you've lost that money. There's no getting it back, right? And so options are the makeup of the stock market. If there's one thing, I get so many DMs every single day of my life. It's ridiculous, okay? A sick amount of DMs. And I try to get back to as many as I can on my Instagram, but it's a lot of DMs all the time. And on all types of different things, people ask me questions of and all these different things, right? And if there's one thing I see common, DM, in terms of like people being down and out, and like it's just a negative thing, is options. I bought, put options on the stock. I bought call options on the stock, and I'm down 85%, 65%, 93%. What do I do now? Those sorts of things. That's always like the number one bad DM I get is somebody bought a bunch of options in a different stock out there. Always the worst one. And, it's just like I see it on a day-to-day basis, because like I said, you buy into this stock or that stock, it's always like, hey, as long as the long term, I'm right about the long term is future, the stock's going back to wherever I bought it at, plus a lot more than that. With an option, you're under such a time constraint. You have time decay potentially working against you if you're a buyer, right? And so there's just, like I said, it's the makeup of the stock market. It looks great from the outside, and then you get into it, and it's way tougher than you really thought, okay? Hope you guys enjoyed this. Hope you got a lot of value out of it. This is issues I see going on in the stock market right now, but like I said, save this video to your notes. Come back to it every once in a while, because this is a timeless video that will be relevant for, many, many years to go in the future. So yeah, and once again, get the pinned comment down there, and don't forget to use referral code Holy Smokus. Much love, and have a great day.